Hey guys, welcome back to another episode. In this video we will share with you the best and most aggressive RSI setting for candlestick patterns trading strategy. So, this is a very simple yet profitable scalping and swing trading strategy for every trader. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. And don't forget to share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Candlestick patterns trading strategy with RSI divergence indicator. In this video we will share with you the best and most aggressive RSI setting for scalping and swing trading strategy. So, are you confused with not knowing exactly how or when to enter into a trade? With so many different candlestick patterns, traders can get paralyzed by overanalysis on whether a certain candlestick is an entry or not. As a trader, we have many things to analyze at any given time. If you take too long to decide whether it's time to enter into a trade because of your complicated entry rules, it might mean a missed opportunity for you. But what if you had a simple way of knowing exactly when to get in and out of your trade without any complicated analysis? Then you want to consider this strategy, trading candlestick patterns with RSI divergence indicator. Because RSI is way better than stochastic when it comes to divergence detection. It generates less signals but very high accuracy. And now, in this trade setups, we will look for two features. First, candlestick patterns. Second, RSI divergences. If you are not familiar with the concept of oscillator divergence, no worries, here's a short introduction. In a nutshell, divergences occur when the RSI does not support price action. This diagram illustrates a bearish RSI divergence. When price action pushes to higher highs, we expect the RSI to do the same. When the RSI does not, we observe a bearish divergence. In the opposite situation, as price action pushes down to lower lows, we expect the RSI to go lower as well. If the RSI does not do that, a bullish divergence is present. Trading rules. RSI divergence with candlestick patterns. The rules are straightforward. In essence, we watch out for RSI divergences to set the context before pinpointing an entry with candlestick patterns. Rules for long setup. First, bullish RSI divergence between the 5-period RSI and price action. In this strategy, 5-period is the best and most aggressive RSI setting for scalping and swing trading. Second, enter a long position with a bullish candlestick pattern when the RSI line is rising above 50 level. Rules for short setup. First, bearish RSI divergence between the 5-period RSI and price action. Second, enter a short position with a bearish candlestick pattern when the RSI line is falling below 50 level. For identifying RSI divergences, simply follow the RSI divergence indicator signals. This is one of the most accurate indicator for detecting RSI divergence. It generates less signals but very high accuracy. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Trading examples. In each of the 3 examples in this section, we marked out the divergence and candlestick pattern we identified. Example number 1. 3-point divergence. This daily chart of Euros United States dollar, our RSI divergences indicator, shows 2 consecutive bearish divergences, also called a 3-point divergence. First, As prices pushed higher, the RSI made a lower high which completed the first bearish divergence. However, the RSI line is above 50 level, so we sat on our hands. Second, the market made another high after some sideways movement. However, the RSI did not make a higher high, and we got another bearish divergence. Although prices tested a new high, the market could not close above the previous trend extreme. This failure was a bearish sign. The next day completed a bearish engulfing candlestick pattern, and the RSI line breaks below 50 level. So we shorted. Third, risk is managed via reward-risk ratio. If you are going short, the stop loss is placed just above the top of the consolidation from which you are entering the short from with minimum reward to risk ratio is 3:1. Example number 2. Losing trade. Once again, this example shows a daily chart of the Euro's United States dollar. Its liquidity and volatility make it suitable for active trading. Let's take a closer look at this failed trade setup. First, prices pushed to a lower low, but the RSI formed a higher low instead, forming a bullish divergence. Second, bullish pin bar candlestick pattern formed with the bullish divergence, and a long setup presented itself after the RSI line breaks above 50 level. However, the trade went sideways for around 2 weeks and stopped us out. Our stop loss was below the bottom of the consolidation from which we are entering long from. Third, however, after our losing trade, the next bullish divergence formed. Eventually, the bullish engulfing candlestick pattern booked a profitable long trade. So, in losing trades, there's usually one of two issues. We got the context wrong, or we got the timing wrong. In such situations, the key is to ensure proper risk control and a plan to re-enter if possible. The candlestick pattern offered a neat stop-loss level that helped with risk control. Example number 3. RSI divergence scalping strategy. This scalping strategy is basically allows to its users to do trade at a specified time frame, such as 5-minute time frame or 15-minute time frame. The usage of the time frames is on the choice of the trader and investors. This chart shows the 15-minute candlesticks of British pounds United States dollar. So, let's take a closer look at the trade setup. The first trade. First, prices pushed to a higher high, but the RSI formed a lower high instead, forming a bearish divergence. Second, a bearish engulfing candlestick pattern formed with the bearish divergence, and the RSI line breaks below 50 level. So we shorted. Third, the stop loss is placed just above the top of the consolidation from which you are entering the short from. The second trade. First, prices pushed to a lower low, but the RSI formed a higher low instead, forming a bullish divergence. Second, a bullish engulfing candlestick pattern formed with the bullish divergence. So enter a long trade if the RSI line breaks above 50 level. Third, the stop loss is placed just below the bottom of the consolidation from which you are entering the long from. The third trade. First, prices pushed to a higher high, but the RSI formed a lower high instead, forming a bearish divergence. Second, a bearish engulfing candlestick pattern formed with the bearish divergence, and the RSI line breaks below 50 level. So we shorted. Third, the stop loss is placed just above the top of the consolidation from which you are entering the short from. The fourth trade. First, prices pushed to a higher high, but the RSI formed a lower high instead, forming a bearish divergence. Second, a strong bearish candlestick pattern formed with the bearish divergence, and the RSI line breaks below 50 level. So we shorted. Third, the stop loss is placed just above the top of the consolidation from which you are entering the short from. The fifth trade. As prices pushed higher, the RSI made a lower high, which completed the first bearish divergence. However, the RSI line is above 50 level, so we sat on our hands. Here are other examples of the candlestick patterns trading with RSI divergence. To fully understand this wonderful strategy, and to make the most out of it, The best part is, divergence is universal. It works in many markets across all time frames. So using RSI divergence indicator to find exhausted trends helps to improve the odds of a reversal trade. It generates less signals but very high accuracy. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.